Welcome to CatEye US Stock. We watch markets with calm focus and sharp instincts. Tuesday, January 20th, 2026, started with a jolt. The first session after the long weekend turned into a full-blown risk-off day. Stocks sold hard as traders scrambled to price President Trump's surprise threat of 10% tariffs on key European NATO allies over his Greenland push. The S&P 500 sank a little over 2%, the Nasdaq even more, and volatility snapped higher. Earnings were on the calendar, but headline risks stole the show. From the Heatmap, you could see the story instantly. The S&P 500 board was a thick sea of red. Giant, bright blocks for NVDA, Apple, Amazon, Tesla, Alphabet, Meta, Broadcom, all bleeding and visually drowning out the rest of the screen. Semis and software were the epicenter, with big banks and cyclicals joining the retreat. Only scattered green showed up in healthcare, staples, a bit of energy, and utilities, tiny islands in an otherwise risk-off ocean. That visual bled straight into the money flow. Trump's tariff threat, tied to the Greenland dispute, pushed investors back into a familiar playbook. High beta, globally exposed tech, communication platforms, and consumer discretionary names were sold to raise cash. AI semis, cloud infrastructure, EVs, and big internet platforms took the brunt as traders degrossed rich winners. On the other side, money quietly hid in healthcare, staples, select energy, and precious metals proxies, favoring predictable cash flows and hard assets over long-duration growth. That rotation left the market sitting in an uneasy middle. Trade war muscle memory came roaring back, but this time pointed at European allies and at the multinationals that dominate today's indices. AI and mega-cap tech, which had felt untouchable, suddenly looked vulnerable to higher long-term yields and tariff uncertainty. We saw a real stress test of the AI boom, not just an earnings wobble. With the VIX back above the 20 line, gold and silver at records, and defensives catching a steady bid, the message was clear. Risk appetite's been clipped, and the burden of proof is back on the bulls. Around the street, the chatter only added to the tension. Unconfirmed talk made the rounds that European policymakers were prepping a coordinated response to Trump's tariff push. Desks flagged a so-called Sell America trade showing up in some macro books, selling U.S. equities and the dollar while buying metals. At the same time, traders were openly debating whether this tariff shock could be the catalyst for a real valuation reset in crowded AI infrastructure names. Important to stress, this is rumor and positioning talk, not confirmed policy, but it helped keep pressure on mega-cap tech all day. A critical debate is emerging in the AI industry, and it's not about chips, it's about data. Cloudflare CEO Matthew Prince says Google holds a structural advantage that rivals simply can't match. According to Prince, Google's web crawler sees more than 3 times the number of pages OpenAI does, with Microsoft and Anthropic operating at far lower levels of access. That edge comes from decades of search dominance. Websites routinely grant Googlebot privileged access behind paywalls and restricted content, creating a data moat competitors can't easily replicate. Prince argues this is why Google's Gemini models continue to outperform, because in AI, data volume and data quality matter more than hardware or talent. The market's starting to reflect that shift. Gemini 3 is now outperforming ChatGPT across reasoning, coding, and multimodal benchmarks. At the same time, ChatGPT's web traffic has declined sharply, while Gemini usage continues to accelerate. The message for investors is clear. AI leadership may increasingly hinge on who controls the data, and right now that advantage sits squarely with Google. NVIDIA sat right in the blast zone today. The stock fell more than 4% as part of a broader unwind in AI semis after the Greenland-linked tariff headlines hit. Traders focused on how a renewed trade fight and higher long-term yields could stress lofty AI valuations and global demand assumptions. Desks reported heavier put activity and defensive positioning around NVIDIA, a tell that some funds are finally taking chips off the table in one of the market's most crowded longs. Broadcom was hit even harder. Shares slid more than 5% as high-beta semiconductor names were dumped on the tariff shock and rate worries. Recent valuation and margin concerns didn't help, but the key takeaway is how quickly sentiment can flip on so-called must-own AI hardware. Broadcom's deeper slide versus some peers underscored that when macro risk collides with extended pricing, even core positions can become sources of cash. Apple told a different kind of story. The stock dropped around 3%, even with fresh Analyst upgrades and bullish iPhone talk on the tape. Investors focused instead on Apple's heavy international footprint and the risk of retaliatory European tariffs. When Apple sells off on good news, it's a clean signal that macro and positioning are steering flows, not near-term fundamentals. Amazon moved almost in lockstep with the broader platform complex. Shares fell roughly 3 to 4% as traders marked down globally levered e-commerce and cloud names on the tariff shock. The stock is a key proxy for both consumer demand and cloud spending, so seeing Amazon trade as a tariff victim underscored how broad the de-risking was. This wasn't stock-specific news. It was the market taking a hatchet to growth leadership. Tesla was another lightning rod. The stock lost about 4%, dragged lower by the tech sell-off, renewed concern over EV supply chains, and focus on Elon Musk's in-house AI chip push. With earnings ahead, pre-event de-risking met macro fear in one high beta name. Because Tesla sits at the crossroads of EVs, AI, and speculative growth, its drop amplified volatility across retail-heavy and options-driven tech trades. United Health was one of the rare bright spots. Shares rose a bit over 2% on solid earnings and guidance, standing out on a blood-red screen. Investors leaned into United Health as a classic defensive growth story with predictable cash flows. That bright green block on the Heatmap was a clean signal that money wasn't just leaving tech, it was actively rotating into healthcare defensives. On the hard asset side, silver stole the show. The iShares Silver Trust surged more than 5% as silver, alongside gold, ripped to all-time highs. That kind of move highlights how aggressively capital swung from growth equities into metals as a hedge against tariff and bond market jitters. The Silver Trust spike sat in sharp contrast to the red in AI names and crypto proxies. Crypto told a very different safe haven story. The Grayscale Bitcoin Trust dropped more than 6% as crypto proxies weakened alongside other speculative assets. That decline came even as gold and silver rallied, suggesting this scare drove investors toward traditional hedges, not digital ones. For now, the Bitcoin Trust is trading more like a high beta risk asset than a macro hedge. So where does this leave the next few sessions? Near term, any new headlines around Trump's proposed European tariffs could swing futures and set the tone at the open. Moves in long-term Treasury yields matter just as much after today's backup in yields compounded equity stress. Positioning will also pivot around a heavy earnings slate, upcoming consumer confidence data on the 27th and the January 28th FOMC meeting. The Fed's expected to hold rates roughly steady, but markets will listen closely for any read on geopolitical volatility and financial conditions. Wrapping up, this wasn't a full-scale capitulation, but it was a message. A 2% down day in the S&P, led by its biggest winners, says tariff risk is back on the table. AI and high multiple growth now have to prove themselves in a tougher macro tape. From here, the market's next chapter will be written by policy headlines, bond yields, and how bellwether earnings stack up against these new uncertainties. Thank you for watching CatEye US Stock. Stay curious, stay calm, and we'll see you next time.